Hi CA students, let's revise CA Final AFM Chapter 3 Advanced Capital Budgeting Decision Illustration 8. So the requirement of question is, if investment proposal cost 45 lakhs and risk-free rate is 5%, calculate net present value under certainty equivalent technique. So what is the certainty equivalent technique? Certainty equivalent technique is nothing but my future expected cash flows. I will take a certainty equivalent coefficient and multiply with that expected cash flow. Then that value I'll discount it with the risk-free rate, and then I'll arrive at an NPV. If the NPV is positive, then I'll go ahead with the project. If it is negative, then I will not accept the project. So let's dive into the question now. Expected cash flow for first year is 10 lakh and certainty equivalent coefficient is 90% or 0.9, and then for second year 15 lakh, third year 20 lakh, fourth year 25 lakh, and the certainty equivalent coefficients are given. So as I previously told, certainty equivalent coefficient is, so how did they arrive at this certainty equivalent coefficient? It is nothing but the certain cash flow divided by the expected cash flow or the risky cash flows. So in this, indirectly, if I multiply 10 lakh into this 0.9, I'm getting 9 lakh. So this signifies, I'll explain with an example. Let's say I'm investing 45 lakhs in this investment. What if I invest this in a bank FD or sweep FD or something like that, some deposit or some other option, and I'm certain that I will get 9 lakh in the first year, but in this project I am getting 10 lakhs. So out of this 10 lakh, I can say 9 lakh is certain, even if I do some other option or something. So with this 45 lakh, I am certain that I'll get 9 lakh in the first year, discounting with the risk-free rate. Same way, they've calculated what if the 45 lakh of investment will give me a return of 15 lakh into 85%, which is nothing but 12 lakh 75,000. So the same 45 lakh investment will give me a return of 12 lakh 75, which is certain in my second year, like before discounting for 5% risk-free rate. So the same way goes with third year and fourth year. So that's how this certainty equivalent coefficient and certainty equivalent cash flows works. So if I multiply this expected cash flow into this coefficient, I'll get a certain cash flow, which I am as an investor is certain about that cash flow. So after comparing all this certain cash flows and discounting with the risk-free rate, which I'm sure about, after this, if I'm getting an NPV, then I will proceed with the project. So in this case, it is 5,34,570, which is positive, so I can go ahead with the project. If it is negative, then I will not accept this project. Thank you.